Thanks everyone for having me. Um, Today, I want to spend a few minutes on how we got to this point and what can investors do to navigate this new environment where yields and returns are extremely low. But more importantly, the structure of markets has changed dramatically, has become less rational and more polarized. So we'll talk about some of the things that I wish I had known when I was a student, when I started my career, and that I've learned over time navigating the markets. There's a lot of content, and sometimes it will be a simplification, but it makes sense to. It would be, it would be wrong probably to start with the current situation without looking at how we got here. So we're going to talk a bit about the past, the remote past, the start of the current economic system, the recent past, the present, and the future. We currently live in a world where there is a very, in the US and the UK, there's a very extreme version of capitalism with very limited government regulation, very low corporate tax rates, and a very strong winner-takes-all effect, where 1% of the population in the US owns 50% of the wealth, where the lowest quartile in income of society still lags the first quartile by around 20% unemployment. So the weak have been hit a lot harder by this crisis. But capitalism has not always been like this. It's not always been about having no shame is making as much money as possible, or in winners being miles ahead of losers and an economy being so divided. In fact, if we think about the history of capitalism and the concept of the invisible hand, the idea was that private participants would maximize their benefit and at the same time maximize the common good. What we know today is that this concept has been transformed over the years. There were decades where state intervention, fiscal policy, and tax systems were a lot more comprehensive in the economy, where the role of government was a lot bigger, following the ideas of Keynes and fiscal intervention. But over time, this translated into, the hand of the government was, which is the visible hand, effectively, which adjusted capitalism and markets for their failures, was gradually substituted by the invisible hand. And the idea that markets are perfect, that they always price assets correctly, and that always allocate resources efficiently. What we know today is that some of this framework has failed, and that we are living with the costs and the collateral effects of market failure. And today we need to learn two things. We need to learn how to navigate the current situation and potentially understand how things will work out in the future. So the way we think about the current financial system, the current economy, is in two words, is fiat credit. Following World War II, we had a period of fast growth in the 50s and 60s, which worked very well as Europe and Japan were reconstructing, rebuilding, and demanded a lot of US goods. As growth declined in the late 60s, and also new generations of veterans with the Vietnam War were asking for more rights, for more inclusion, the US responded with essentially what was the American dream. If you can't afford a house, if you can't afford a car or education, we'll lend you the money. And so we started we went from the Bretton Woods Agreement to the breakdown of the Bretton Woods Agreement. But more importantly, we shifted from the gold standards to fiat currencies and later to fiat credit. The creation of subsidies, the use of private credit for boost, for the short-term growth purposes. What the former RBI governor Rag Rajan called lending credit policies. And since then, with financial deregulation, we got a boost to credit, to private credit, up to 4 times GDP. China and Europe and the UK caught up later on. But the aftermath of this, one of the conclusions of this is that productivity and interest rates have continued to go on a downward path. Now, if a government creates a lot of debt in history, we have seen that this usually translates into a following period of very low interest rates. The temptation to use central banks to keep interest rates low, to fund your deficits, is usually very high. And this translates into very low returns for investors, sometimes negative returns against inflation, in some cases very deeply negative. Today, we find ourselves in an environment where deficits and debt levels are similar to post-war periods in the past, and where financial repression is becoming a reality with real interest rates and negative levels. But what is the reason for this? Well, the reason is that perhaps when governments have exchanged long-term fiscal stimulus, infrastructure, investment, research, education, for short-term lend-them-it credit policies, they have chosen the path of short-term growth, of sugar rush type of stimulus versus long-term boosts to productivity. And in fact, we see that productivity over the last decades has continued to decline across developing countries. So this puts really into question the idea that government fiscal stimulus, Keynesian fiscal stimulus, is always the best policy, and that people can repay public debt because there's growing demographics and there's growing productivity. So the denominator, the GDP, will always be bigger. But in particular, it puts under question the idea that inflation is always a monetary phenomenon and that Friedman-type policies were always correct. So in other words, that low interest rates today may create higher interest rates tomorrow. It worked very well in the 50s and in the 60s and the 70s, when you had growing populations and you had growing productivity. Does it still work in the world today? Well, we know that in some areas of the world, like Japan, we have balance sheet recessions. We had lost decades, and Europe is going in a similar way. We define this as the QE infinity trap. Essentially, monetary policy is used as the main tool to recover from a crisis. It does work in preventing the worst from the crisis, as it probably did in 2009, 2010. But it also introduces a range of collateral effects. Similarly to keeping a patient under anesthetic for a very long time, initially the anesthetic reduces the pain, but then later on it creates a lot of collateral effects. And these collateral effects affect supply. They keep low interest rates, if they're persistent, they keep zombie companies alive. They can produce a misallocation of resources in industries where capital would not otherwise go. Think about real estate, for example, or very leverage-heavy sectors like shipping. Also, they change low interest rates. If they're persistent, they change incentives on the demand side. Savers initially see their wealth rise. They see stocks going up. But then if you know that interest rates are low for longer, you also know that you're going to have to save more for retirement. So you don't necessarily feel richer. You may at some point feel like you have to save more. You may feel poorer. And finally, in markets, and the BIS has done all the work there, low interest rates can create asset bubbles, which initially are inflationary, but then when they burst, create a very deep and long deflationary impact by leaving non-performing exposures on investors' balance sheets or bank balance sheets. And this is exactly the balance sheet recession definition. a persistence of non-performing exposures across corporates, across banks, across private sector balance sheets, households, and high debt levels in governments. A situation where everyone is focused on deleveraging and very few are focused on investing. So today we are at a crossroads. We need to understand whether there are the necessary reforms and stimulus to be able to get out and improve productivity and get out of the QE infinity trap, or whether we will stay for much longer in a liquidity trap and in a financial repression environment where investors will be essentially taxed for the overhangs of debt accumulated in the past and for absorbing the overhangs in industrial capacity that have been generated in the past. Now, the easiest way to exit a balance sheet recession is to reduce your balance sheet, but it's not always easy. And here we see that the US offloaded 60% of its losses during the 2008 crisis in financial markets. While Europe kept, for example, Europe kept 95% of losses on bank balance sheets, simply because there's lack of capital markets and banks make up most of the European financial system. So if you are the US and if you have the world reserve currency, you can easily reduce your losses and you can essentially offload them to the financial system globally, and investors are still going to buy your currency in your treasuries. However, if you are in another country, then things are a lot more difficult. So a lot of economic assumptions that we learned in the past are coming under scrutiny. And if you thought markets were always efficient, you probably have to revise that. If you think that trickle down works, you have to revise that. If you think that technology also is inflationary and boosts productivity, also you have to rethink that, because in the past people were buying more cars. Today technology is about using resources more efficiently. It's better for the environment, but it's also deflationary. And in terms of monetary policy, if you think that low interest rates today were bringing higher interest rates tomorrow, then also you have to think about that in the context of the transmission mechanism and how different financial systems are able to transmit monetary stimulus. So what is the market telling us today? The market is telling us that essentially it doesn't believe that stimulus will work. This is the ratio of central bank driven assets, so treasuries, investment grade, tech stocks that are embedded, that have growth embedded in their business model, versus cyclical assets like the Russell or high yield bonds, for example. And central bank assets have been outperforming for many years for now, from the start of QE, with the exception with an exception made for the past few months, where the market started to think about fiscal stimulus and maybe a turn into turning point in policy. The reality, though, is that the amount of policy intervention so far has been really large. And if you look at the growth in money supply that we had across developed economies, in this case the US, versus money velocity, you can see why the stimulus has been inefficient. You're essentially flooding the environment with liquidity, but this liquidity is not transmitted to the rest of the economy. So in other words, we are living today in a system where we've used for several decades private debt as a way to boost consumption and to control business cycles, really since the late 60s. The fiat credit world has gone to a point of crisis, though, in 2008, where too much debt and where private debt being a multiple of GDP essentially created a very deep crisis with long-term consequences. And only the US economy was able to restructure private balance sheets relatively quickly, while many other economies in the world remained affected by NPEs. Now, monetary policy came to the rescue, and essentially it reduced the downside risk during this crisis. But today we have to live in the red scenario here, in the red line, where essentially we are living with the collateral effects of QE infinity. Asset bubbles, rising inequality, which in turn creates a polarized society, corporate inequality as well as social inequality, misallocation of resources, and lower productivity. In other words, this is always talked about as secular stagnation. Now, secular stagnation is associated with low productivity, is associated with hysteresis, the scars that economies keep following a crisis, but it's also associated with inefficient government intervention. Now, during the crisis of 2020, a sudden stop in global growth and mobility caused one of the steepest declines in GDP over the last 100 years. Governments reacted with record monetary stimulus and also record fiscal stimulus. And here in the US, we see a potential of over 20% of GDP in fiscal spending. This is going to raise government debt across the world. But the question is, how will the economy come out of this COVID crisis, and how will companies and sectors be compared to where they were before? Now, monetary policy and fiscal policy, if they are top-down, if they are one-size-fits-all tools, they have a very low, not great track record of helping the economy. They help the economy to rebound, they help markets to rebound. What we're seeing today is a V-shaped recovery. But then if we look within the economy, under the hood, we see a very K-shaped situation. And here we want to talk about productivity and the economic system. And what we see is that in the United States, for example, the persistently low interest rate environment, the lack of regulation, micro policies have encouraged consolidation. So you have a crisis, you have stimulus, you have a recovery. Only companies that act in the bond market generally are able to benefit from the lowest yield possible. These companies tend to be the largest ones, and essentially you end up with a winner-takes-all effect. So the economy consolidates. There's always winners and losers, but the winners are winning persistently. So there's consolidation across sectors between pre and post-COVID. And look at what happens in certain sectors where you end up with a few dominant players, like in the tech and retail space, or in the telecom space, where companies have been consolidating with M&A over the years, favored also by low interest rates, or in the banking space. Essentially, in the US economy, you end up with an oligopoly or a monopoly across most industries, from toothpaste to soft drinks to banks to cars to processors. And guess what? If you're in a forest with very high trees, there's a lot of shadow, there's a lot of shade, and you don't have any sunlight for new trees to grow. And so the startup rate has gone down. The mobility of workers has been going down because companies are entrenched and there's only a few employers per state, per sector. There's a very good book on this called The Myth of Capitalism, which essentially says, capitalism is a great idea, we should try it. Because the US economy in the last decades, with a mix of monetary policy, asset-based policy focused, corporate tax cuts focused, stimulus, and a lack of antitrust has essentially become entrenched. And here you get to one of the key points in this discussion, which is the elephant chart. I mean, the world is better off versus where it was 100 years ago, but who has been the winning part and who are the losers? Well, in emerging markets, the poorest people, global poverty has been reduced. The poorest part of the world is earning more. In developed markets, which you see on the right side, however, the middle class has basically remained at zero. The median real wage in the US has been stuck there for 30 years. And then at the very top end of the top 1% of the population, you essentially have holders of 50% of the wealth. Corporate inequality, lower productivity, and social inequality obviously are linked. And there's a lot of ways of thinking about this. But in the end, inequality, record high inequality down to the 1800 levels, and a very large gap between what corporates are bringing home to their shareholders versus what workers are bringing home. All these things in the end boil down to politics. And this crisis in particular has increased the level of inequality with a stimulus that again is a one-size-fits-all stimulus that has failed to lift the poorest states and the poorest parts of the population. And this brings us to the policy response tomorrow? Because we know that the policy response today has not worked. So what is the policy response tomorrow, and how do we learn to navigate this environment as investors? Well, one of the important things is to understand populism and to understand what populist governments have in common. And looking at the Dornbusch-Edwards analysis of governments in South America, we essentially evolved to the modern, we adapted it to the modern economies. And we understood that populist governments have three things in common. One is that they sell you a dream, which is a dream that's unrealizable. You know, Brexit with Europe paying for it, or going back to the industrial might of the US in the 70s, basically turning back time, or in Italy, you know, just giving more money to everyone, which is more blunt. But also these governments polarize inequality and anger against an enemy, usually a foreign country or immigrants. More importantly, though, they perpetuate, they engage in unsustainable policies, which are aimed at perpetuating this dream and remaining in power. And very often, these policies end up in negative outcomes for the economies in question. Very often, these governments end up using currencies as a way to stay in power rather than as a store of value. They end up running large deficits, misallocating resources, entering trade wars or even military conflicts. Today, we have several countries which have gone into a potential populist regime. But the Dornbusch-Edwards approach, very interesting, tells us something that we didn't know, that initially the populist regime, once you have the preconditions, once the populist regime starts, enters a positive phase. So initially, the spending and the deregulation and some of the measures taken by populists have a positive impact on the economy. It's only after a while that the negative impact starts happening. Today in Europe, we have a few examples of post-populist governments. Probably the first one has been Greece in developed markets, with Ukraine being the first example in emerging markets. Now, it is our job as investors to understand how each country is moving in this map of policy responses and how to deal with this decline in productivity, whether countries are going to take the right steps to rebalance productivity and fight secular stagnation versus ending up in a liquidity trap and in a balance sheet recession. With the COVID crisis hitting global mobility, essentially what markets are telling us is that we're in a V-shaped recovery. Mobility has rebounded, although the decline in the past few months has been tough, but we expect the vaccine to continue to immunize the different economies, particularly in developed markets. And we expect herd immunity to be reached between the middle and the end of this year, depending on the speed at which the vaccine will be deployed. And so far, we see the US and the UK ahead other countries. We think governments will reach full capacity in deployment around the middle of this year. And this would push us roughly to reach herd immunity to 70, 80% towards the second half of the year, depending on the speed of vaccinations. And again, the picture that the market paints is a V-shaped picture with 5-6% growth in the US and inflation going back to above 2% in the US. But some parts of the world are behind. And we know from what we have discussed before that reality is a lot more looking like a K within the economy. So how do we invest in this market? How do we think about markets that are telling us the world is V-shaped and everything is fine, while we actually know that the real economy is not? Well, we start from a very tough picture because we know that valuations are a lot more expensive than they were in March last year or that they were 10 years ago. So price earnings are much higher. Credit spreads in high yield and equity volatility are also much lower. And more importantly, interest rates against inflation, real interest rates are negative, especially, here we see the impact of inflation in the US, pushing real interest rates at minus 1.1%. So especially if you're a bond investor and you're looking for yield, you need to be worried about the return of capital, not so much the return on capital. If you want to beat inflation, essentially you know that you don't have many options. And actually, one of the casualties of the COVID crisis, besides the human cost, has also been the risk-free rate. Governments are using central banks to push interest rates, to keep interest rates low, to fund themselves and create fiscal stimulus. But at the same time, they're imposing a tax on savers. Today, there is only 10% of global bonds yielding over 3%. This was roughly half before the 2008 crisis, and roughly 40% in 2018 when the Fed tried to taper its quantitative easing program. So you're really left with taking either credit risk or market volatility risk or currency risk if you want returns that are bigger than inflation. Conversely, if you're buying government debt or if you're buying investment grade or buying BTPs, there's very little room for error, only at 20, 25 bips of widening. So basically less than a 1 standard deviation move in the market can wipe out a year of returns. So why are investors still buying BTPs or buying investment grade bonds or buying treasuries? Well, the answer is that central banks have entered a Faustian pact with investors. They've come to you, and we're speaking to people in the UK today, but they've come to you and they told you there's going to be 360 days of good weather, and investors accept it. If you follow central bank support, you'll have 360 days of sun. But what investors didn't know is that the 5 days of rain are hurricanes or earthquakes, because everyone is dancing and trading and investing to the same tune. And so central banks have not only lowered short-term interest rates, but with forward guidance and QE, they've also lowered the long-term level of interest rates, the long-term term premium of interest rates, but also the volatility of interest rates and the volatility of credit. Essentially, they have rewarded investors that bet that the world tomorrow is going to be the same as the world today. They've rewarded investors betting that volatility will stay low. But if everyone does that, then when there is an unexpected event, then you have an extreme volatility event. And these events have become more frequent. In other words, the tail of volatility across equity and credit markets has become bigger. When it rains, it's really bad. When VIX goes above 20, it goes to 50. It doesn't stop at 20 or 25. Another important observation is that assets in an environment where central banks determine the fate of risk assets and the market as a whole by moving interest rates, and they're the only traffic light, then assets will move increasingly in tandem. We saw that in March 2020, both equities and stock and gold and treasuries, so risk-free and risky assets, moved together. They went down together. And the intraday correlation of assets has become increasingly more positive, which leaves investors very few places to hide in a sell-off. Equally, trading liquidity becomes more binary as well. Here you see the discount on credit ETFs, even investment grade ETFs during the March crisis, which could have gone deeper should the Fed not have bought these ETFs. Obviously, the environment, the polarization in markets, which reflects the polarization in the economy, is made even worse by herding and by the proliferation of passive strategies, which again work very well for 9 years out of 10, but when there is a reversal in the central bank stimulus, they end up suffering a lot more and all at the same time. In turn, essentially what we're saying is that the economic system has become more fragile. If you think about nature, and I've borrowed this and elaborated this table from Antifragile, Taleb's book. If you think about nature, there's very simple examples that evolution has given you about fragility, robustness, and anti-fragility. Dinosaurs went extinct because they were big, they relied on food, they needed a very specific ecosystem. Turtles are very robust, but there's also animals that thrive from chaos, like bacteria that can survive very negative or very, very hot temperatures. In mythology, you had the Hydra, where if you cut one head, you had 2 more coming up. And in monetary policy, probably the worst thing you can do to increase fragility is to push everyone in the same trade. You essentially make markets a lot more dependent on future stimulus. Similarly, across corporate capital structures, keeping interest rates low and using a lot of debt instead of equity makes companies more fragile, again, making the economy more dependent on stimulus. So where are we going from here? We've got two very different views of the future, two different scenarios. One is very utopian. It's an environment where technology is used for everyone. The gains from technology are shared. The governments manage to improve productivity, to rebalance the burden of taxes, to reopen education. And if you're old enough to remember Back to the Future, that's pretty much a world that's maybe a little bit better than today. Not utopian, but definitely not worse than today. And then there's another scenario where technology drives inequality further, opening a wedge between the rich and the poor, between large and small companies, which goes to the point of people prolonging their welfare and their lives, almost dividing our species into two, into rich and poor, into rich countries and poor countries. A world that is less utopian, is almost dystopian, where governments are unable to fix the system and to make it sustainable again, and where inequality drives a bigger wedge across populations and across policy decisions. Today we have an attempt, probably the best attempt that we have to exit secular stagnation in the United States, with the Biden administration having pledged $1.9 trillion emergency stimulus in Q1, and potentially another 1 to 2 trillion stimulus in the second half of the year, focused on infrastructure investment. Now, it is key to understand, our biggest question is to understand this stimulus, to understand whether investment in education, investment in infrastructure, an adjustment to the tax system, a rebalancing of corporate tax, all these things together will be able to restart the US economy, to boost productivity again, and to make this growth more spread and more equal across the poor states and the stronger states, and poor parts of the population and small businesses, as well as large companies. This is really the big bet on the US economy, and potentially later on also in Europe if the recovery fund becomes bigger. There's no answer yet because we don't know the composition of the second tranche of the plan, the one that's going to be more aimed at growth and productivity. But if we fail, if we are wrong, then the world that we are going to live with is a world where probably we'll have more of the same policy stimulus, more of the same central bank easing, which will not go through higher growth and higher productivity because the transmission system is impaired, because velocity of money is low, and essentially because liquidity by itself boosts assets but does not always boost growth in the real economy. If we fail, also we'll see the Western approach to capitalism being challenged. Today we have essentially three blocks. We have the US and the UK with a very laissez-faire approach to capitalism, with a belief that free markets always work. Then we have Europe in the middle with a socialist and capitalist mix, where markets are aided by the visible hand of governments. And then we have China, which has been dealing with the crisis a lot better, that has more room to boost debt in public balance sheets, also has been able to take longer term decisions. The PBOC is the only central bank that's not easing. The Chinese government has been trying to control debt overhangs and not make the same mistakes that Western policymakers are making. So if we fail, if the US fails to exit secular stagnation, one of the things that we could see potentially in the future is China getting a larger share of global GDP, but also getting a larger share of trade and reserves and global reserves, with a potential decline in the dollar. So this is essentially what is at stake, a transformation between countries that have entered liquidity traps, trying to exit these liquidity traps, but also a geopolitical angle where power is moving from west to east. And here you can see the Asian currencies recently, while in the past they were moving closer to the dollar, recently they've been moving more strongly with the yuan. And here is one of the charts that worries me the most across central banking, which is that 80% of central banks across the world are working on central bank digital currencies. This is not Bitcoin, it's a digital yuan, a digital euro, a digital dollar. Now, if fiscal policy does not succeed in pushing back growth to sustainable levels and inflation, if governments are forced, and central banks are forced to continue along the QE route, along the route of monetary easing, kicking the can, then digital currency could become a very bad idea for investors. Of course, China is doing it to give a means of payment to the Belt and Road countries. Of course, the digital euro is something that will go along with cash, as Lagarde said at her last press conference. But imagine a world where cash is banned and where digital currencies are the only means of payment and they are controlled by central banks. What would be the limit for interest rates to go negative in that world? Would be definitely a lot more negative than they are today, because investors may no longer be able to hoard cash and deposit physical cash at zero. So we are again at a crossroads. As investors, the biggest question that we have today is trying to understand how the financial system and the economic system is changing. The neoclassical, neoliberal economic policies that governments have engaged in the 60s, 70s, and 80s and 90s were successful in a world where growth was working, where populations were growing, and where technology was inflation, when everyone wanted to buy 2 cars or 3 cars. We're no longer in that world. We have deflationary technology. We have record low interest rates. And the perpetual motion machine based on credit, on fiat credit, no longer works. So how do we restructure the system? Well, we have many bank-centric economies like Europe and Japan, which are stuck in a balance sheet recession. It's much harder to get out of it when you have only one source of financing. Here, central banks have missed the window to normalize. But we also have some hope in the US, where capital markets are nimble and where the NPEs in the balance sheet have been outsourced. However, the US economy has essentially gone into a policy mix still made of monetary policy and corporate tax cuts, which increased inequality, increased monopolistic behavior, and reduced productivity, reducing competition, reducing the heart of capitalism. So the biggest question is whether the Biden administration will be able to shift away from short-term policies to long-term policies that boost structural growth in the long term. If we fail, then we will go into another liquidity trap. And history tells us that we will likely continue to see the easiest policy choice being made, which is debt monetization. Governments using their currency for survival, pushing low interest rates and low returns into savers, and savers being forced to accept these very little or negative rates of return on their capital. As a result, as portfolio managers, as investors, we are worried about the long term, and we're worried about preservation of capital and return of capital. The way we build our portfolios is very different today. We don't think the 40-60 portfolio works any longer. We don't think risk parity works any longer. And we think that a barbelled portfolio construction approach, very selective today, where optionality is maximized, where investors hold cash for optionality, more cash in their portfolios, and only assets that have symmetric returns, like, for example, some higher risky part of the bond market or convertible debt, are preferable to being fully invested in government debt or in triple Bs or in BTPs, which are today manipulated assets by the central banks. Ultimately, and I'll end here and go to Q&A, it is about incentives, and it is about skin in the game. And this is a painting representing Ulysses navigating close to the Syrians. Now, he was a sailor, and he was tempted by discovering what he didn't know. A bit like a portfolio manager may be tempted by making returns or discovering things that may make more money. But he knew that there was a short-term decision there. Getting too close to the rocks would cause his boat to crash and the sailors to be eaten up by the Syrians. So what he did was to try to align his incentives to the long term. And he did that by putting wax in the sailors' ears and tying himself to the mast. So when we look at policy choices and when we look at investment choices, it is important to have long-term incentives. And even if you want to pass very close to the sirens, to make sure that you don't get too close and you continue to aim the ship for the long term. Thank you for your time.
Thank you, Alberto. Absolutely fantastic presentation.